So again, market really hasn't done anything drastically wrong. It's certainly getting some pressure from what's happening in Israel right now. That'll pass here in the next couple of weeks, and everything will reverse from that, right? So gold prices will go down, oil prices will drop as we get past past this whole kind of war fear thing. And then once that does, then we'll start to see the markets kind of balance back out again. But again, we're getting a lot of just initial kind of noise around what's happening, and this will sort itself out shortly.
Welcome to Wealthion. I'm Wealthion founder Adam Taggart, welcoming you back here at the end of the week for another weekly market recap featuring my very congenial friend, portfolio manager Lance Roberts. How you doing, Lance?
Good. How are you today?
Good. Just trying to think of a good synonym for likable, and I think congenial hits the mark.
There you go.
All right. Well, the market didn't find too much that it liked this week. S&P down about 150 points by the time we're talking here at the end of the week, Lance. Sort of seems like fear of many things is in the driver's seat right now. We got oil up $3. Gold is up really big over the past 2 weeks. It's up from like 1835 to near 2000 an ounce at the time we're talking. The 10-year just briefly kissed 5%. Even Bitcoin, is on a tear now at about 30,000. So what's going on?
Amazing what a few bombs in Israel do for you, right?
Yeah.
So
sadly.
Yeah, that's it. I mean, is
that pretty much it? Just fear of Mideastern contagion?
Yeah, that's it. And again, this is just headline driven moves in the market. Market was doing fine Monday and Tuesday. We were holding up near the 50-day moving average, and then all these kind of headlines hit, and so you get this kind of knee-jerk reaction until we kind of sort this out. And as I talked about with Fox Business earlier this past week, I had a chart of the history of the markets going back to 1900 with all the different kind of war events that have occurred, conflicts throughout history, whether it was the Civil War, or whether it was World War I, World War II, and you always get these initial kind of knee-jerk sell-offs in the market because nobody really knows what the outcome is going to be, and there's always concerns about this is going to spread into some vastly bigger. And so understandably, people could take defensive positions in that environment. But again, historically, this sorts itself out pretty quick. The markets will get its handle on it. And actually, wars are good for markets because it increases economic activity.
Okay. All right. So, well, speaking of technicals and whatnot, maybe you can pull up the chart of the S&P, Lance, that we like to look at every week if we can, just to sort of show folks where we are. And once we pull that up, and I've got to give you authority to do that. But once we pull that up, if you can also maybe dial us through the Simple Visor charts as well, just to give us a sense of what sectors are oversold, what are undersold, vice versa. Sure,
absolutely. So again, the market's not done anything really right or wrong or indifferent. We had triggered a buy signal, MACD buy signal earlier this month. Now, importantly, we're still in October, and you remember I wrote this article right at the end of September. I got to keep my months in line, talking about October weakness, and I said it's very likely we could continue to see some weakness through October because until we get into November. That's when the window for stock buybacks occur. That's when you have your biggest inflows into ETFs and mutual funds for end of the year. So again, this kind of October weakness kind of continues to play itself out. But we had talked about earlier this week in our both in our 3 minutes on markets and money that we do every day, and also in our daily commentary that we write. We talked about the fact that this market was trapped between the 20-day moving average and the 50-day moving average, and if we broke to the downside of that, then we were likely going to test the 200-day moving average, which is where we are today. So we're testing support at the 200-day moving average. Markets are not overbought by any stretch of the imagination. So again, market really hasn't done anything drastically wrong. It's certainly getting some pressure from what's happening in Israel right now. That'll pass here in the next couple of weeks, and everything will reverse from that, right? So gold prices will go down, oil prices will drop as we get past this whole kind of war fear thing. And then once that does, then we'll start to see the markets kind of balance back out again. But again, we're getting a lot of just initial kind of noise around what's happening, and this will sort itself out shortly.
Okay. So just looking at some of the action here. So we are coming down, looking at the S&P chart there in the middle, to the black line to the 200-day moving average, right? Yep.
Absolutely. Yes.
Okay. So sounds like you expect that to serve as resistance here, but
that'll be support.
Sorry. Support. Sorry. Support. Okay. Floor.
Right. And then if we go through 4,200, then we're probably talking around 4,150-ish as kind of the next level of support, because that's going to run across these previous tops. This was the breakout level that we had back in really kind of June of this year. We based back in October, came off that floor, then kind of traded sideways February, March, April, May, June. The market really went nowhere for about 3 months. And then we just exploded once we broke out of that big consolidation channel. We kind of exploded to the other side. So now we're going to come back down. And this is a very normal technical process as well. So we had this big breakout move from that consolidation. And so the market got very excited. So in June, July, we were up 15% for the year on the S&P. So for the market to retrace that, come back down and kind of retest that breakout level support is kind of a natural process of the market. It happens all the time. And if we hold there, now that's the key word, if we hold there, and the market rallies, and we'll have a confirmed breakout of all that previous consolidation. So that's going to be a really good, solid support level between this 4,200 level and say 4,150, somewhere in there. That's a kind of real critical support for the markets. Now, if we break through that for any reason, then we're going to go a lot lower. So, again, we'll have to, reposition portfolios if that happens. But again, right now there's nothing to be too overly concerned about. It's a lot of headline risk. Don't want to diminish that at all, but I'm seeing a lot of nonsense and headlines and stuff in the markets that are extrapolating, these issues into much bigger problems than they actually are.
Got it. Okay. So just to recap, you think that the probability is more likely that the market will find support down here at some point. Maybe it drops below the 200-day moving average. You said 4,150-ish is kind of the next key level of support. But then market finds its footing, we bounce back, maybe end the year strong. And we've talked about a number of potential reasons why that could happen. Sure. If it drops below 4,150, 4,100, then you think things could really accelerate to the downside. Who knows? We'll be tracking this closely. Looking up at the MACD indicator up there, yep. which last time we talked, it was rising nicely. Now it seems to be short-term peaking a little bit. But that pink circle there with the lines crossed, was that a buy signal? Is that what
that was your buy signal? And normally when you get buy signals from these very oversold levels, you get kind of extended rallies from those points. So again, right now we're very close to triggering a short-term sell signal. That's not uncommon, by the way. If we kind of scroll back, in time, here was another example. This was the October low. We triggered that buy signal, then came back, triggered a sell signal, and then flipped right back over into a buy signal again. So again, this was kind of the same action that we saw back in October. Market rallied nicely, triggered the buy signal. We give it all back up. Everybody's panicking. Oh my gosh, we're going to go a lot lower. And then the markets took off. So again, when you're at low levels like we are now, these kind of head fakes on buy and sell signals can occur. But normally when you're at fairly low levels, as we are now, these are generally pretty good indicators that you've got a more bullish upside. Now, if this kind of flip-flop was going on at a much higher level, then which can also happen, you can also have a buy signal. And here's a good example of this. This was the peak of the market back in December and January of 2022. So we went up, we triggered a sell signal, and here's where we triggered a buy signal from a fairly high level, and then triggered a short-term sell. Then the market ran back up. We had a declining top, which was a negative confirmation. Then you triggered a sell signal, and that really kind of started the ball declining. So when you kind of get these flip-flops of buy and sells at high levels, that's normally a bearish signal. At the bottom, you can have these flip-flops back and forth. But when the markets are oversold and have been through a kind of a big decline, those are typically, not always. Now, look, there's, technical analysis is technical analysis, just looking at prices and making some assumptions. But normally when you have a deeply oversold condition, in terms of these MACD signals, et cetera, those tend to be pretty good indicators. Again, they're not perfect. You can have these flip-flops sometimes. We could very well trigger a sell signal, come back down to this previous level. The market declines to 4,000. Then you get another buy signal, and that's the buy signal, right? So there's certainly risk, and this is what we talked about all week long, is making sure to keep watch on risk, because there is certainly some downside risk here. It's not all just flowers and candy at this point, but the odds are that in November, December, heading into year end, markets are likely to be higher than they are now.
Okay. And so I just want to clarify here, we have that buy signal. We have not yet triggered a sell signal, correct?
Right.
Okay.
Now, again, and we're kind of midday here on Friday. So, if the market rallies into the day end, then that's going to pull that indicator back. This is a real-time indicator, so it's tracking moves every 15 minutes. So if the market turns around and rallies back into positive territory by the end of the day, then that's going to pull that indicator back off that signal. So again, it's just going to depend on where we end the week.
Okay, great.
And by the way, let me just say one more thing. Just because you break a moving average, again, we could break the 200-day moving average. That's not a sell signal. What you're looking for is confirmation. So if we took out the 200-day moving average today, let's just say the market just sells off into the end of the day and we're below the 200-day moving average, that's not a sell signal. What you're looking for there is for the market not to regain that level on Monday or Tuesday. A lot of people talk about, I don't like technical analysis, you get whipsawed. That's because people see a signal and they immediately act on it. When you're talking about moving averages and support levels, what you're looking for is confirmation. In other words, you break a support level, you come back and retest that support level and fail. That turns that support now into resistance. That's your signal to reduce risk. And so again, these support levels are only valid after they've been tested and retested again.
Okay, great. All right. Well, look, if we can, let's oh, by the way, so I forgot to mention at the beginning of this video, folks, while you're watching this weekly market recap, Lance and I and all the other financial advisors for Wealthion are actually busy with Wealthion's fall conference. So Lance and I wanted to film this for the folks that weren't joining the conference so that you got your daily dose of Lance and Adam. But we were very busy at that conference listening to the amazing presentations there. And I got to tell you, Lance, probably the one I enjoyed the most was, having seen a preview of it, was Tom McClellan's presentation. Tom McClellan, his family developed the McClellan oscillator, highly, highly respected technical analyst. He's got an amazing array of charts that have just these really crazy, oftentimes like super unintuitive correlations. We have a data series like oil or gold that may actually, it's highly correlated with other asset classes. Like oil's correlation with the general market indices is actually pretty amazing, but they're time shifted, right? And so it can be amazing because some of these are time shifted by a quarter or two. Some of these are time shifted by a year. Number of ones related to oil are time shifted by like 10 years, and it's amazing how the correlations hold up, even though there's a 10-year time shift in the data. Anyways, long story short, his charts tell him that the markets are more likely than not, to end the year higher, right? So it's another vote of what you've been warning people about. And then his charts tell him that there is going to be kind of a wheels come off the car moment at some point in the next, and I'm going to put this out as a teaser, in the next 6 to 18 months. And his charts tell him essentially down to the month when he thinks it's going to happen. So super fascinating. Lance, you're going to really enjoy that. And I'm sure you're probably enjoying it live with me right now, because at about this time when this video goes live, it's probably when Tom McClellan's presentation is going live. Super interesting. But I just want to let you know, he's corroborating your, hey, don't, if you're on the bearish side, make sure you're not too vulnerable to the market ending the year higher. But also, God, he's got some amazing fireworks that he expects coming up in the not too distant future.
Yeah,
All right. So, go ahead.
no, absolutely, but absolutely agree with that because you and I talked about recession next year, probably second, third quarter of next year. These interest rates it was interesting. If you listen to Jerome Powell's speech yesterday, he said the market yield is restrictive. We're expecting slower economic growth, lower rates of inflation. And that's what he wants, right? So he's keeping that one rate hike sitting out there. We've talked about this before. He can't take that off the table. When he said yesterday, as an example, during his on Thursday during his news conference, one of his comments is that we think yields are sufficiently restrictive because of what's been happening in the yield curve, and immediately yields started selling off, and you saw bond prices go up, yields go down. So then he had to come back and back that up with, but we could still hike rates if needed because economic growth is still a little bit too strong and we need it to be weaker. And then yields ran back up again because of this theory of one more rate hike. So they can't pull that off because the Fed knows if they pull that rate hike off, that everybody's going to run right into bonds, and then that's going to pull yields down. That's going to give support for the economy, which is exactly not what they want right now. Because they want slower economic growth. They don't want a recession. They're going to get one because they always do. But I agree with Tom, is that next year, that's going to be a year where bonds massively outperform stocks, and you don't want to be in stocks next year.
Got it. Yeah. I will say my beating of the drum of the lag effect really mattering. Let me just put out the teaser. A lot of the presentations in our conference are heavily validating that. I'm curious, Lance, I'm just asking you to guess here, but in terms of the Fed having over tightened, at this point, how severely would you rate their level of over tightening? Smidge, a tremendous amount? Where would you put it?
They're going to figure out pretty quick that they should have stopped hiking rates probably 5 or 6 meetings ago. But again, they're always a day late. In fact, that's my article for Friday on our website. It's called "The Fed's Waterloo," and
we're getting to that, by the way. I've got that here on the agenda.
Well, and the whole point of that is that they may win the fight on inflation, but they're going to lose the war on the markets. And right now, they think that they can fight this inflation fight. And if you take a look at their projections for economic growth, they project no recession over the next 5 years. So yeah, they're going to win this war, as Napoleon won lots of wars until he got to Waterloo. When that's the economic war that they're going to lose next recession, it's going to be a lot worse than people think. It's not going to be a little recession. It'll be a fairly decent recession. Now, I'm not talking financial crisis. Don't go get your bunker hat on. But we're going to be talking about probably 6% unemployment rates. You're going to be talking about much slower economic activity, probably going to be talking about a fairly decent surge in corporate bankruptcies. And the Fed is going to have to do a lot of QE to start trying to bail all that out.
Yeah, which is, I showed a chart a couple weeks ago on this program of the Fed's forecast for the Fed funds rate. Mm-hmm. And it is just this gentle drifting down over many years. I think it's like 4 or 5 years from now, where it finally gets back down to like 2. And you and I looked at that and we were both like, it is going to be so much more violent than that.
Well, and again, all you have to do is look at it. What amazes me is that, the Fed is 400 PhDs, right? And there was a good comment about this. There was an article in the Wall Street Journal on Thursday. And I talked about it with Michael Leibowitz on our YouTube channel, that the Fed says, don't worry about student loan repayments because it's only going to be about $56 a month for individuals. That's all it's going to be. But later on down the article, it says there's 22 million borrowers. They have saved because of the moratorium on student loan payments. They have saved like $220 billion over the course of the last, 2-3 years that they haven't had to make student loan payments. They've had this excess money to spend. And so if you just do the math, 22 million borrowers, actually it's 44, but who's counting the difference?
I was going to say, I've heard in 40s, yeah.
Yeah, it's 44, but hey, it's the Fed, so it's half, right? So, but you take 22 million borrowers, you take $220 billion that they were able to spend on other stuff, divide that, right? And you come up with a $215 a month average payment. So if their average payment was $215, how are they only going to contract by $56 when their payments restart? It's just, this is the nonsense that comes out of the Federal Reserve to try to, appease people. And you have to kind of read through the ledger of it. But, this is why if you go back and look at history, there has, do you find, look, I will buy the best steak dinner for anybody that can find me a period of time where the Fed cut rates slowly over 3 or 4 years.
Right. And especially into a recession, right? I mean, if you just look at every recession, in living memory, they hike, the recession starts and then boom, it's an elevator down. Yeah.
Exactly. And it's every single time. So, it's just, this, but again, they can't, you have to remember the Fed can't say what they really want to say, because if the Fed had come out yesterday, on Thursday, and said, hey, you know what, we're done hiking rates. We're seeing a lot of fractures in the economy. We just got a letter from the National Association of Realtors said if we don't stop hiking rates that, we're going to blow up the housing market. If they said any of that stuff, immediately you'd be in a recession. Immediately you would have interest rates falling through the floor. Immediately the wheels would come off the cart. So they can't say any of this stuff. And yet the markets act like they actually know what they're talking about. So it just, you got to just, kind of chuckle and move on with life.
What scene comes to my mind when you say that, because we've talked about this. The Fed will never say, hey, we think we're engineering a recession here. It's that scene from, the movie Airplane, right? Where, everything starts shaking and they're telling people not to panic, and the sign's blinking, don't panic. And then it switches to, okay, panic, right? I think that's what it would be like. All right. And hey, just real quick, to that, your anecdote there about the Fed and student loans. First off, I've never heard of anybody that has a $56 student loan payment, right? Yeah. And secondly, interviewing Stephanie Pomboy yesterday for the conference, she said that the number she had was that the repayment of student loans is basically going to take 200 billion out of the economy next year.
It's about 15. I ran the numbers, and it's been a little while since I've done it, but it's about 15 billion a month. So, yeah, if you run that out over 12 months, you're starting to push up on
getting that ballpark. Yeah, and that's that's not nothing, right? All right, so you were going to the SimpleVisor data, and then we got sort of sidetracked by this. Why don't you pull that back up?
So just a couple of things. I mean, and, just kind of where we are again. We're kind of looking for where opportunities exist. Consumer discretionary, transportation, materials, industrials, real estate, financial, those all have interest rate or consumer spending components to that. So those have been under the most pressures of late. Money's still hiding in, energy, technology, and kind of these big cap names. And that's not surprising. It's the passive indexing effect that we've talked about before, the, big mindless robot.
Yeah. Hey, also, sorry to interrupt, but just real quick, does green mean indicators are reading oversold,
yes,
or is there a different way? Okay.
No, green is oversold. So that's when those are a good time to increase holdings in those areas. When they're red, they're overbought, and that's a good time to reduce those holdings. And if they're gray, they're kind of in the middle. You're not getting a great signal either way.
Okay. Oh, and I just saw overbought and oversold. Yeah. You've got your key right below there. I should have looked.
Yeah. Now, again, we have to, if we slip it, now this is relative. So that's just relative performance to the S&P. If we look at absolute, so this is absolute performance. So, this is just, the absolute performance of the sectors versus their kind of overbought, oversold condition. So this isn't comparing it to the S&P. This is just comparing it to itself. When you get to this world, you can see that energy is grossly overbought, and basically everything else except healthcare and communication is really oversold. And so, when you start digging in, looking for opportunities, it's very rare that materials, as an example, is this oversold. And this is what this top chart is. It's very oversold on a relative basis. And then, when we kind of look down into its kind of top holdings, Lindy makes up 20% of that entire index. So, also we have to take into account the impact of, these these passive ETFs. So if you buy basic materials ETF, you're buying 20% of lending in your portfolio. So, but you start digging through, Freeport McMoran, all these, except for Corteva, that's the only one that's really not oversold here. The rest of them in this sector are pretty deeply oversold at this point from a basic material standpoint. So there's some opportunity on the basic material side, but you got to have some caution here. If we get into a recession, economic growth slows, materials are going to continue to underperform because they're economically sensitive. On a short-term basis, you may be set up here for a year-end rally for the next month or two. This is short-term analysis. So always keep this in mind that, this is, you've got a setup here that maybe materials will rally into year-end. Now, once we get to next year, all bets are off. So just kind of keep that stuff in mind.
Okay. Wow. It's so funny. That map is so different from the way it looked back in July. Yeah. Which was, I think, one of the last times we pulled this up and looked at it, where, almost everything was in the red, right? We had like almost every sector crowded up into that top, what is it, the top right quadrant there of the oversold.
Yeah. And that's so this is right. So this is relative versus absolute. And to your point, back, in June and July, all these sectors were crammed up in the upper right-hand corner where they were all overbought. Now, except for communications and technology at this point, and when you talk about communications, that's Google, Netflix, pretty much, and then technology is Microsoft and Apple. So, and NVIDIA. So, those have come down a lot. Those were like in the far upper right-hand corner. Those have come down a lot, but you can see the rest of the market is now pushed back into fairly oversold territory. And if we look at factors, so factor performance is, small cap, mid caps, mid cap value, semiconductors, all that. So when we start looking at, all these different kind of factor performances, those are all now, down into that lower left-hand oversold category. Emerging markets, international have been under a lot of pressure. Kind of a large cap value has been under pressure. The only thing that's really kind of, sticking up here in kind of the overbought kind of territory is precious metals. Yeah. Which is still holding up right now.
Okay.
But what this
made a huge run in the past 2 weeks, which is probably explaining that, right?
Exactly. What this suggests is you sell precious metals and you start digging around maybe in emerging markets or international. I'd be a little bit cautious on those just because those economies are very weak. But you start kind of looking at, kind of more of your value sectors for a rotation out of commodities back into value sectors.
Right. And look, I'm a big long-term fan of precious metals for many reasons we've talked about in this channel. But yeah, when you have a move this big that is largely, it seems, being driven kind of by headline emotion, it's vulnerable to, some sort of resolution in the headlines, and all of a sudden, it loses $100 an ounce in a very short period of time, right?
Yeah, and look, I mean, precious metals it's a fear trade always. It's not an inflation trade, it's not a currency trade, it's a fear trade. So when you have a lot of fear, people buy gold. It's just the offset for fear. And so right now it's playing well because of what's happening out in Israel. As soon as you get any resolution, gold will sell off. So, we bought gold in our all-weather model about a month ago. It's performed well. We're probably getting ready to reduce that position and swap that into value.
Yeah. Hey, could you do me a favor? Could you go back to the previous chart where you had the different sectors?
Sure.
The one that had the communications and the tech companies in the upper right quadrant.
Oh, sorry. Yes, that was the actual sectors, not factors. Just 1 second.
Yeah. And all I want to corroborate with you is, the markets have come down, pretty substantially, over the past couple of weeks, right? We were like flirting with 4,500 or something like that, and now we're in 42 something.
Yep.
Right. And I just want to corroborate with you that that's mostly due to these two, the communications and the technology sectors becoming a little less overbought versus everything else falling into the oversold category, right? Just because those 7 stocks just make up so much of the market cap, right?
No, that's absolutely right. I mean, if we take a look at, technology as a function, so this is relative. So this is, relative to the overall index, overall to the S&P. They just make up such a big chunk of that. And you're right, the technology was very overbought. It's now come down. It's kind of in a neutral kind of spot right now. So, when you take a look at this is kind of why this is the case. So when you buy XLK, every dollar you put into XLK, 23% of it goes into Apple, 22% of it goes into Microsoft, 4 goes into NVIDIA. So you have 50%, 50 cents of every dollar goes into 3 stocks.
Yeah. All right. And again, I just want to underscore here, kind of like our conversation about gold and headlines, right? Which is just, if the Magnificent Seven catches a cold, like the entire rest of the financial markets is catching pneumonia.
Yeah. And it's really, here's the problem. I don't know what causes that. Because of the passive flows into ETFs and mutual funds.
And sorry, but you're saying you don't know what's going to cause it to catch a cold, right?
Correct. Right. Yeah. Because these are the companies that are generating growth, right? In terms of earnings and revenue. They just print money. They're basically monopolies in their industries to start with. So, I mean, you're not going to displace Microsoft or Apple anytime soon. And Apple's very, it's always funny because, I was having I was doing a video, the other day, in a video interview, and we were talking about Apple versus Android, and they were just, kind of picking at me because I'm an Android user. And I'm like, well, you're 1/4 of the population. I'm in the 3/4 of the population, right? So you don't realize that, Apple users only make up 1/4 of all mobile phone users, but they just print money, every year. So, what's going to cause that to derail and all of a sudden say, oh, valuations are a problem? This is one of those situations where Apple has got to stumble in some manner where they can't grow earnings at all, and they can't grow revenue. Nobody wants Apple phones or Apple products anymore. Mm-hmm. And then they've got to become.
Although to be clear, they are not growing revenue currently, correct?
This is a very true statement. But then my next statement after that was, and then you've got to figure out how to reduce their market cap weighting in all these ETFs, because again, it doesn't matter what the company does. When you're 22% or 23 or 25%, depending on what ETF you look at, when you're 1/4 of that index, and when the top 10 stocks make up 33% of the entire S&P 500, every dollar that goes into S&P funds, and think about all the people now in 401k plans and individuals, nobody's buying stocks anymore. They buy ETFs, and you're just fueling those top 10 stocks. So it's very hard. We keep looking around, well, what's going to cause this to derail? I don't know what's going to cause it to derail, because you've got to break the ETF flows in order to break those stocks.
Yeah. I made a note, actually, when I was talking to Bill Fleckenstein. He mentioned Mike Green several times, and Mike is being sort of the expert and to a certain extent the creator of the term giant mindless robot. Yep. So I'm going to have Mike back on to do kind of another current deep dive into that. And that's one of the questions I'll be digging into him, which is, hey, we're all worried about some potential day in which the giant mindless robot starts going in reverse. What could cause that? What do you think is the likely trigger for that?
Well, what you'll need a 2008 type financial crisis where you literally panic people into just selling everything they own. So in other words, they just start dumping ETFs at random. Hey, I just want to get out. The market's down. Look, a 20%.
Well, capital flows, right? If net inflows become net outflows, the giant robot turns into a vacuum cleaner, right?
Exactly. And so, but let's just look at it real quick. The 20% correction that we had in 2022 didn't spook anybody. As I wrote multiple times, through 2022. There were too many people that were emailing me, go, where's the bottom? I can't wait to buy this bottom. Where's the bottom at? Because man, I want to be in. I want to buy these stocks. And again, there were a lot of stocks down 80, 90%, like in the ARK funds, right? Those stocks got decimated. But everybody was just on pins and needles. They had FOMO of trying to find the bottom. And I go, well, this isn't going to be the issue. So, I mean, we've got to get to a point to where people go, I don't care about where the bottom is. I just want out of the freaking market because, I don't want to lose any more money. When that happens and they begin to just dump spider ETFs and XLK and, just every holding, all these ETF holdings just to get out of the markets, then that flow of money runs in reverse. 30 cents of every dollar is coming out of the top 10 stocks, which is going to cause those prices to drop dramatically.
Wow. If that were to happen, that'll be bedlam. I shouldn't be laughing when I say that, but yeah, hopefully we can avoid that type of scenario. But it's one we got to be mindful of. All right, so thanks for going through the world of equities there with us. Let's now trundle over to bonds. So as I mentioned earlier, the 10-year kind of kissed or came within a whisker of kissing 5% this week. I'm sure you get asked, questioned by nervous bond investors, every 3 milliseconds, Lance. So first off, I don't
really understand everybody's like, oh my gosh, you touched 5. We were like 4.8, 4.9. You're talking about a tenth of a bit.
I got 4. I think it's 4.99.
Yeah, but we were 4.94 the day before. So yeah, it went to 4.99. I mean, you're just talking about market movement from one day to the next. It's not some, giant move. It didn't go from 3 to 5 overnight. Now that would be a different.
It doesn't, but we all have a memory of it back, at one something not that long ago.
Well,
right?
Of course, this is called hindsight bias, right? And so we all have hindsight bias, and this is where it was, and now look where it is, and so we come up with all these dramatic statements, and that's okay. I mean, there's nothing wrong with it, but this is where you start making all your financial mistakes, right? This is where you start panic selling things and making all the wrong moves in your portfolio. You're worried about something that's not a problem. And again, just, Mike and I spent a long time on Thursday going through bond math. We have girl math, we have guy math, and now we have bond math. So, we went through bond math on Friday, and look, Adam, it's like, here, let me give you an example. Okay. You have $1 million to invest, and you can only invest in one thing. And if I told you, here's an investment that has 29% downside and 72% upside, are you interested?
I mean, I'd have to see what you're comparing it to, but it sounds sure. I'd hear the pitch.
Yeah. Okay. And by the way, you have a guaranteed return of principal function on top of that. So your risk is 29% downside, 72% upside with a guaranteed return of principal at maturity.
Yeah. It sounded pretty good now. Yeah.
So that's a 30-year treasury. So if interest rates go up 300 basis points, your downside risk is 29%. If interest rates go back to 1.5, which is what they'll do during a recession, your upside is 72%. So, why would you want to make that investment?
Right. No, I mean, you and I have talked about why, it's historically very attractive here. Now, of course, the big question everybody is, but I don't want to buy if it's going up to 7 or 8 and it's going to stick there for the next 10 years or whatever. Right. And part of me asking this is for you to tell people if anything's changed in your thesis. I don't think it has, but let folks know. And I'm also trying to tee up your restrictive yields article. So that's where we're going with all this.
Well, no, and this is the thing that people also miss out. So, right now you can buy a 5-year treasury, right? That pays roughly 5%-ish, right? And so you're getting a 5% return over the next 5 years on your money, regardless of what interest rates do, right? So why wouldn't you want that?
Yeah.
And it's fascinating. And here's what's fascinating to me, Adam, this whole thing. So when interest rates were at 0, right, and stocks are climbing through the roof, right, I cannot tell you how many investors, everybody was convinced that since 2011, there were some very famous, people that were on all the media channels saying, oh, we're going to have a massive crash, a bear market's coming, the financial crisis isn't over. A lot of these guys that are massive short sellers, Bill Fleckenstein and others, they were all out there. We're gonna have this massive crash. So for 12 years, they were calling for a massive crash, and it never occurred. But during that entire time frame, I had people come to me and say, "Look, if I could just get 4% on my money, I'd be happy. If I could just get 4%, you can get 5%."
I went on this diatribe yesterday, which is, I think for you, like, forget 10 years ago, during 2022. I lost count of the people saying, I just want to have, if I could just get 4% on my money going forward, I'd be in heaven, right? And now it's like, okay, you can get more than that now.
Yeah. And they're like, well, what if it goes to 6? What if it goes to 7? So what? You said you'd be happy at 4. Now I'm going to give you, a 20% increase in that rate of return. and you're still not happy. But see, this is the whole problem with the financial markets and why investors consistently underperform over time. I wrote an article on Tuesday.
To be clear, sorry, it's not the problem with the financial markets, it's the problem with human behavior.
Right, which is the article from Tuesday on the website called Unintended Consequences. And I go through the 9 behaviors of investors and why they consistently underperform markets over time. Because
we're going there too.
Okay. So you have all these reasons. 50% of the reasons why people underperform the markets are all psychological. So, and this is because you worry about stuff you don't need to be worrying about. And the coolest thing about the bond market versus the stock market is this. You can calculate to the penny when you buy a bond exactly what your return is, period. I mean, you down to 1 cent, you can, know exactly what your returns are. But you can't do that with stocks. You can't do it with gold. You can't do it with any commodity or a currency. There's no way to calculate with certainty what your return is going to be. We can guess at it, right? We say, we're going to get 6% on this or whatever it is. But with a bond, a CD, anything that has a guaranteed, return of principal in the future plus an interest rate, you can guarantee yourself what your return is going to be. And all you got to do is be happy with it.
Yeah. And again, that's where human nature comes in, right? The one thing you don't know is, well, on a relative basis, is that going to be a good return or not for the next 10 years, right? And you can kind of talk yourself into knots, right? But you're making, one of the key principal points why we encourage people to work with a good financial advisor, which is, as humans, our emotions more often than not influence us to make the wrong decision at the wrong time for the wrong reasons. And an advisor is sort of like a reality check on you, right? Where they can say, look, hey, whoa, okay, buddy, I get the emotion. Let's talk it through. Let's go back to the math, right? And they hopefully can help prevent you from making the worst of the emotionally driven decisions. All right, well, so you made like several of the points I was going to make. But anyways, so yields are where they are right now. And you've always said, look, hey, they may go higher, before they start going lower, but I know for sure that Michael is still very much on a great time to buy bonds train because he's delivering that right now, that message right now at the conference. I assume you are too. Let me ask you this. I want to go to your article about restrictive yields will be the Fed's Waterloo, because like them or not, attractive as a bond investor or not, cost of debt at this height with this economy is toxic for the economy the longer, and it's more corrosive the longer it lasts, right? So I want to get to your Waterloo point here. Real quick though, so Bill Fleckenstein is quite bearish on bonds. He is totally open to the fact that there may be a bounce in, the relatively near future, meaning between now and 18 months from now or whatever, right? So the thing I think you and Michael are playing for. But he thinks that inflation will be more intransigent for the coming decade plus. And he thinks that, deficit spending will be higher. And he thinks that bond yields will generally be higher for the next decade plus. So he's not saying your strategy right now is wrong, Lance. He's saying, sure, it could work out, right? But he's saying, as I look forward to the next decade plus, I'm much less sanguine on bonds than I'd say was in the past 20 years. What's your reaction to
that? Everything he said, that interview, because I got sent it by, probably 20, 30 different people that watched it. It's like, oh my gosh, what do you think about this?
Yep.
Everything he said is entirely wrong.
Okay. All right. So basically you have a different, and hey, Bill, I mentioned to Bill, other people
no, it's not me having a different opinion. Everything he said is factually wrong about how interest rates and inflation work over time. And there was another guy that got emailed to, and his name escapes me at the moment. If I think of it, I'll tell you. But he was using a bunch of my charts and doing a podcast that he was doing, and he's like, "There's no precedent for the amount of debts and deficits that we have in the U.S. right now. There's no precedent of this." It's like, really? Go look at Japan. Japan has been running, 30% deficits for the last 30 years. Their interest rates are zero. They're doing yield curve control to keep their interest rates from going negative. So, none of those factors that are mentioned are even close to being factually correct. So over the next decade, the risk that the U.S. runs is more debts and more deficits, lower economic growth, lower inflation, lower interest rates, worse economic prosperity. I worry for my kids and what their ability to generate an income is going to be over the next 10, 20, 30 years. They will not have the opportunities to create capital like boomers did, like Gen Xers did.
Okay. Interesting. Certainly not looking to pick a fight between you and Bill Fleckenstein. And Bill and I talked about the fact that, hey, people have different opinions, and hey, it's smart people looking at the same data and coming to different conclusions is what makes a market. If you think there's sort of more kind of fundamental, like, hey, I think we've got different facts here, maybe, if he's open, maybe an interesting, polite discussion between the two guys would be interesting, and I'm happy to host it if you want to. But
don't host it with me, host it with Lacey Hunt.
Yeah, and speaking of which, I just saw Lacey's slides yesterday.
And what's his opinion on the long-term trend of interest rates? In fact, if you want, I can pull up his third quarter report that he just came out, and he says,
"Yeah, I know. Look, I mean, it's Lacey's deflation, right? I mean, that's his big concern." I told him, after I saw it, I said, I'm pretty convinced that my audience is going to give you a standing ovation at the end of this presentation, and then turn around and go stick their heads in the oven.
Yeah, and look, I mean, because again, the people that are arguing. So here, look, let's go back. Right, and this is actually the subject of my newsletter this weekend, which is debts and deficits. The bear's new meme. And Bill Fleckenstein is a great example of this. He's been bearish on equity markets for 12 years. Now he's bearish on the bond market for another 12 years. He's been wrong for the last 12 years, so why would he be right over the next 12 years? We'll see. Maybe he is. Maybe there's some type of environment that comes out that we have higher inflation. But in order to get higher inflation, okay, what drives inflation? What drives inflation is very easy. It's economic growth, it's wages, and ultimately demand in the economy. So what you have to make the argument,
money supply and velocity of money, and
right, and all that comes right back down to economic activity. So in order to have inflation, sustainable rates of high inflation, you have to have sustainably higher rates of economic growth. In order to have that, you need to have rising wages. You need to have more activity within the economy. You've got to have a booming financial sector that's just is able to loan a lot of money to individuals to go buy bigger houses and bigger cars and build more plants, properties, those type of things. So make the case for me about, in an environment that we're in now, how are we going to create that type of economic activity? See, we had that type of economic activity back in the 60s and the 70s, which
sure.
is inflation, because we were able to create $5 for every dollar's worth of economic growth. Today, it takes $5 of debt for every dollar's worth of economic growth. You don't have the capacity to generate the economic activity required to sustain higher rates, which is a function of the consumption equation economy. It's the debt. Debt is deflationary, period, end of story. Deficits are, go take a look. We've been running a deficit now since 1980. The trend of the deficits is lower. The trend of interest rates is lower. They are highly correlated. Debt is deflationary. There's a negative multiplier effect on government spending versus every other dollar spent in the economy.
All right. Sorry, I'm just chuckling here because it's so weird to have you, you're always in the seat of telling me to slow my roll when I start getting on my bearish tirades.
Fired me up. Don't get me going. Yeah. I had coffee this morning.
Clearly, it looks like espresso, double shot. So I'm looking at the time as I'm just going to jump to this one topic. We don't have to spend a ton of time on it. But it's interesting because Lacey goes through, actually I go through the economic data at the conference with several people, Michael Kantrowitz obviously being one, right? That's the E in the HOPE framework. And that was fascinating. Lacey ends his presentation by going through a lot of the like hours worked and average wage data. And it's very clear that is struggling here. And clear that basically companies are shifting full-time hours to part-time hours, and then they're reducing both at this point in time. So the only thing I think that's moving right now on the wage side is these wage increases that we're starting to see in certain parts of the industry. I just wanted to note here that we've got, strikes right now going on in Hollywood, in the automakers industry, in hospitals. Like out here in California, Kaiser's got a massive nursing strike. Now casinos have joined the fray here. And so, who knows what the long-term impact of this stuff is going to be. But in the short term, how inflationary do you think that that's going to be, which is the higher wages that these folks are likely going to get from these strikes?
It's negligible. They're a very small portion of the entire employable workforce. So, they'll get a pay increase, sure. But just like Walmart announced recently, they gave pay increases before. Now they're cutting pays for new hires. So people that they hire now are going to get paid less than the old people. So, again, it's just a function that, you may get more, you may get more money now, but we're going to reduce hiring after you. So, we were going to hire, as an example, in the writers' strike. So, okay, great. You guys, you're going to get more money, but we were going to hire 500 more writers. We're not going to hire those guys now. So it just eventually works itself through the economy, because again, when it comes down at the end of the day, what are wages? Wages are an expense to the corporations. And so when it comes to a function of profitability, which is what Wall Street demands them to produce, right? That's how they make earnings. If wages, and wages are the biggest, wages and benefits are the biggest cost in any business. So when it comes down to net profitability for that business, if wages go up on one side, there's going to be cost cuts somewhere else. And that's either going to be a reduction in the labor force. You may get a raise right today, but you may be out of a job in a month. Right. So, that's why it always works itself out over time.
Yeah. So again, talking to Stephanie, she talked about how S&P earnings are currently projected to grow by 12% next year. And right. She was like, she was definitely taking the under on that bet, which I recognized her for. And she said, yeah, but like, that's not a heroic thing. She's like, that's a pretty damn easy bet for me to make.
Well, look, and just as we always, look, you and I have talked about this before. That's why we call it millennial earnings season. They always, right? It's 220, it's 12% higher now. By the time we get there, it'll be 2% higher or 3% higher. So they always just give themselves,
that's business as usual, right? Yeah. But I think she's also adding into that at some point, there's going to be some sort of reckoning where, some sort of earnings recession where companies are going to have to start, to your point, making the tough cost control decisions that they really haven't yet made. I mean, we've seen obviously more layoffs over the past 12 months than we'd seen in like a decade, right? So, I mean, it's beginning to happen. But I think, that she's thinking what we're seeing now is still a relative trickle to what's likely to come. And what's interesting about that is you're nodding as I'm saying this. So I'm guessing you think, there's decent potential that could happen. We spend so much time when we think about layoffs looking at the big corporations, right? And reading the headlines, oh, so-and-so just laid off, 10,000 workers, whatever. But it's important to remember, and Lacey helped me remember this, which is that small businesses account for 3/4 of all jobs, right? And that's what really matters from a job loss standpoint, right? Because those companies aren't, they're not flush with cash, right? And they have a lot harder time getting access to credit, and banks are in a big tightening cycle right now, right? So, those are the companies that are going to fall and stumble first. And, that's where we can see, a tremendous amount of potential job losses because they're the most vulnerable. So the bottom 3/4 are.
Yeah, they're vulnerable. So most of those businesses have 5 or fewer employees. They don't have access to credit markets. They don't have access to equity markets. They can't go do a secondary stock offering to raise capital to get them through a tough time.
Exactly. Can't tap the public markets for help.
Yeah, exactly. So, I mean, we're seeing bankruptcies on the rise right now. And again, when we get into a recessionary spat, we're going to see a very large chunk of businesses go out of business. And particularly that risk runs high in the Russell 2000. There's about 20% of the Russell 2000 could theoretically go out of business over the next 2 years.
Yeah. Okay. Wow. You definitely got up on the bearish side of the bed this morning. That's so interesting.
Those are just facts.
I know they're facts.
What it is. It's not
usually you're trying to put some sort of nice, polish on them today.
Look, I keep telling you, I think next year we're going to have a recession, and look, it could be late next year. It could even be 2025. Timing the recession is going to be very hard. And, timing the impact of the unemployment is going to be difficult because we never really hired back all the people that we laid off. Full-time employment is still lower than it was back in 2019. So we laid off a bunch of people and we hired a bunch of people back, yes, but we didn't overhire. So we may not get this big surge in unemployment, these big jumps in jobless claims that are normally coincident with a recession. We could still see a recession, but it could be a fully employed recession. Because
I'm going to take the under on that, but you're right, it could happen.
I'm just saying we didn't go through this massive hiring spree. You hear these numbers like, oh, we've created 12 million jobs since the pandemic. No, we did not. We just hired back the people we laid off. So, there's a lot of unemployment out there that exists of people that have never gotten jobs that have come into the.
All right, I'm gonna jump back to bonds real quick because I wanted to give you a chance to talk about your article, Restrictive Yields Will Be the Fed's Waterloo, right? We've mentioned it briefly, but why don't you just kind of cut to the heart of why you wrote it?
Well, this is, kind of the, conversation that was on Thursday with Jerome Powell's statements. He made a couple of very important statements, talking about, additional evidence, persistently above trend growth, or the tightness in the labor market is no longer easing, could put further progress on inflation at risk, could warrant further tightening. And that's fine. He's got to leave that one rate hike sitting out there, in this fight, because again, if he doesn't, it's going to reduce it'll ease financial conditions, which will create inflation. So he's got to kind of he's in a very bad position at this moment because the interest rates are going up, which are creating much more restrictive financial tightness in the economy. That is going to lead to something breaking, and it always has historically, going back, as long as we can track this stuff. There is always a negative outcome from this. We just don't know where it's going to show up. Is it going to be, in the general economy? Is it going to be in the financial sector? Is it going to be in the housing market? It'll show up somewhere. We just don't know where it is. And so the point is he may win his fight on inflation. He'll be able to pat himself on the back and say, yeah, we beat inflation. Yeah, we destroyed half the planet doing it, but we did beat inflation, right? So again, you win the battle, but you lose the war. And the war is ultimately is this is going to cause a bigger economic contraction somewhere, and we just need to be prepared for that. But again, because of the lag effect, it's going to take a while to get here.
Okay, I'm just going to ask this more for historical interest reasons. You compare it to Waterloo, Napoleon's Waterloo, right? Have you ever seen this chart? This is Napoleon's losses on his campaign into Russia, and it's a little hard to see, but it starts here on the left in the beige, the brown chart here. So that's the size of the full army that he departed with, and you'll see here it just gets winnowed down the further and further they get into Russia. And then the black line is returning back to France from Russia. And you see, they're just getting decimated all along the way. So by the time he gets back, he's got this tiny little black line versus, this massive army that he had left with. So I guess my question is do you think it could be more Waterloo or more like the Russia campaign disaster for Powell?
Well, it just, it's interesting because if you look at the graphic that I used on that, I actually used this program. It's artificial intelligence. I said, give me a picture of Jerome Powell as Napoleon. And so it gave me that image. and so, just the idea though, that, when Napoleon went into Waterloo, had just come off a string of victories. He's very confident that he's going to win the Battle of Waterloo, and then he loses badly. And that's kind of the point here. The Fed is very confident they're going to win this, they're going to be able to beat inflation and not have a recession. They are overconfident in that assessment. The economy is going to beat them in this battle. And the question is only when. They're going to get disinflation and actually get deflation when they get the recession. And, they're hopeful that they're not going to have that problem, but, there's really just no way to avoid it at this point.
Got it. Your point is they may succeed beyond their wildest dreams. Well, you got inflation below 2%, but you probably didn't want it that far below 2%.
Exactly.
That's so interesting. Actually, I didn't take a look at that image on the article that closely. I just pulled it up here. That's so creepy that AI just is able to do that so quickly.
It is. I think it literally took about 2 minutes for that graphic.
Wow. I mean, it's a cool graphic. It
Yeah.
definitely is a Napoleonized Powell, but creepy that yeah, that's only 2 minutes of AI work. We're all going to get replaced. There's
I
going to
know.
be the AI Lance and Adam.
I actually have a guy that I pay to draft, graphics for stuff. He's a really good artist, and so we've produced a few of them here and there about Powell and different things from time to time, and Janet Yellen and stuff. And I'm like, well, I just put him out of a job because I don't need him anymore. I just go to this AI program, which is completely free online, and I can generate graphics.
Yeah, that is the wave of the future, for good and ill. Gosh, well, look, when you replace me with an AI generated image on this, Lance, just make sure you give me defined abs, okay?
Absolutely. And that's the creepy thing, is that they have those AI programs now that you just give it an image, you write out everything you want it to say, and I can create an AIU and tell it exactly what to say.
All right. Well, why don't we do this next time? It should be you and Adam Headroom. We'll see how it goes. All right.
Back and forth that makes it work.
All right. There is another chart I'm going to put up here in just a second. I want your reaction to, but while I'm looking for it, here's a headline: China liquidated the most U.S. securities in 4 years to prop up the plunging yuan. There's some charts in this article. Maybe I'll pull them up in a second too, that just show what a net seller China and other foreign central banks have been over the past couple of years. And I guess when you sort of see it visually, it really is kind of striking. Now, I know we've talked about this. The volume of the selling is not existential to the U.S. Treasury market. Yeah. But as these countries get more and more beat up by a strengthening dollar, the beatings will continue until morale improves, or what?
Yeah. Basically, again, the reason that countries buy or sell treasuries is mostly to what we call sanitized trade, in order to keep their currencies kind of closely pegged, since the dollar is the reserve currency, and that's where the vast majority of your trades occur. About 70% of your trades are done in dollars. So they buy or sell treasuries in order to keep that relationship somewhat in line. They can't control it entirely, but they can do that to try to sanitize these trades to keep imbalances from occurring. But let me show you a chart of this, because we can just put this to bed really fast. This has been one of the kind of the misnomers running around the market is, oh my gosh, all these people are selling all of our bonds. Nobody wants our debt. This is net purchases of U.S. Treasuries in billions. The only seller that we have right now is the Fed. U.S. financial sector is buying bonds. U.S. households and nonprofits are buying bonds. Other domestic investors are buying bonds. The rest of the world is buying bonds. Yes, those have come down over the last couple of years, because as we came out of the COVID, everybody, the U.S. wasn't just in isolation, right? The whole world was in isolation. Europe shut down. Everybody was locked down. France and England, everybody, Germany, had all shut down their economies. Don't leave your house. Stay home. Don't do anything. And so there was this big imbalance that went on. You can see that, the purchases, if you go back to, 2000 and look forward, you can see where central banks became involved in 2008. And, we're basically running at levels right now that we've kind of been the average of since 2008 of foreign countries and, other individuals buying bonds. You see that one big spike there in 2020. This is either, half of that spike of that total, in 20 billion in bonds, was 10 billion was bought by the Federal Reserve.
The Fed, yeah.
Yeah. So, but, but right now, there's not these countries aren't net selling our bonds. Yes, they may be selling a little bit here, a little bit there. China owns 800 billion of our bonds, so which is negligible when you talk about 33 trillion. So yeah, they sell a little bit to help balance currency, but this whole thesis that nobody wants our bonds, that's why interest rates are going up. Yeah, that's one of those big fallacies.
Basically, what you're saying is Treasury buying right now still seems to be somewhat near the mean, the historic mean. So there's no real reason to freak out.
Right. And our issuance of debt is actually kind of below its trend right now. So we're not doing this massive issuance of debt. So again, seeing a little bit slower purchasing is important because, again, we don't have a lot of excess demand, but we also don't have a lot of excess supply right now. Hang on a second. Let me show you a couple of charts here. So, this top chart right here is the total federal debt of, what kind of goes on. So you see in the background, the blue line is a total federal debt. And it certainly looks like we're just issuing this massive amount of debt, right? It's just, off the hook. And this is what's got everybody concerned. It's like, oh my gosh, we're just issuing so much debt. It's just crazy. But, when you go back and look at your annualized, 3-year growth rate, over the last 3 years, our growth rate's been about 6% in terms of our debt. So, again, while it may seem like we're issuing a lot of debt, we really aren't. In fact, when we take a look at total federal debt on log scale, so this changes it into percentage terms. We look at the long-term growth trend of our federal debt going back to 1968. We're actually issuing debt at a slower pace than what we were back in the 90s when we were really issuing a lot of debt early on. So again, it's important to keep these things in some type of perspective. More importantly, you take a look at total federal debt as a percentage of GDP. It's declining. It's not growing. You can see that big spike in 2020 where we just went crazy issuing debt to try to bail out all the pandemic stuff. But since then, we've had fairly robust economic growth. So our debt issuance as a function of GDP is actually declining, the total debt as a percentage of GDP. So again, a lot of these concerns that people, are throwing out there about, oh my gosh, this is, we're just issuing debt like crazy and that's why interest rates are going up. No, it really doesn't have anything to do with that. And our debt issuance isn't all that dramatic relative to historical terms. And so if we take a look at inflation versus the U.S. Treasury yield, Treasury yields are trading right about where they should be. What's inflation right now? 3.7, 3.8. So interest rates are a little bit above where inflation is at the moment. Now think about that for just a second. When I'm a bond issuer and I'm loaning money to somebody, so Adam, I've gone through this with you before, but Adam, I'm going to loan you $1,000 and you're going to pay me back over 10 years, that $1,000. So what do I need to compensate for? I need to compensate for inflation. So if inflation is at 3.7, I can't charge you 3.7 because I wouldn't make any money, right? I get my money back on an inflation adjusted basis to be like issuing a zero, right? But, I need to make a little bit of money. So I charge you 1% more than inflation. So 4.7-ish right now, inflation's at 3.7. That's about right where the Treasury rate should be. If we take a look at where real economic growth is, real inflation is at this moment, we're about 1% too high relative to where Treasuries should be trading. And that's just a function of psychological impacts and money movement in the markets and, people shorting shorting bonds heavily right now. That's a big momentum trade that's been driving yields, but yields are about 1% higher than where they should be. Yields should be closer to 4%, not 5%. So again, when you just kind of go through the math and you kind of look at, where we are relative to, the fair value of where bonds are, and go through the period of time, rates should be a bit lower, but not dramatically lower. We shouldn't be at 2% right now. We shouldn't be at 2.5, should be closer to 4.25, somewhere in there, because that's where the economy is actually growing. Now, when you get in a recession, all that math reverses, and yes, you should have lower yields because you have lower economic growth and lower inflation.
Got it. And just to tie it back to your thesis for holding longer duration bonds right now is you are expecting that at some point recession is going to arrive and inflation will drop and therefore yields will drop and therefore bond prices will go up.
Yep. And then when that happens, I sell all my bonds and I buy stocks.
Okay. All right. And speaking of stocks, great transition to this question. Here's the chart I wanted your reaction to. So right now, the 6-month Treasury bill yield is above the current earnings yield for the S&P for the first time since the start of the new millennium here. So what, the past 24 years or so. So interesting time. Guess another reason to be, loading up on bonds right now.
Well, so two things. I have a real
bills.
Yeah, well, I have a real problem with earnings yield. You don't get earnings yield, right? It's just that's the inverse of the PE ratio. It's earnings divided by price. You don't get it if you buy a stock, you don't get a monthly check for your earnings yield, right? If I own a bond, I get an interest payment every quarter
Yeah.
or every year, whatever it is. So I actually get money.
Yeah.
It's a nice calculation. It just said what this does say is that you're better off theoretically right now just buying a 5% Treasury bond versus what you would get out of owning stocks.
Right. I mean, it's showing you on a historical basis, relative valuation. You're getting a much better risk return on a T-bill than you are in a stock right now.
Right now.
Or on the S&P in general.
Yeah, that's great.
Okay. All right. Well, look, we're going to have to start wrapping up here. As always, Lance, great. I'm going to get to your trades in just a second. I did want to go through your consequences are always unintended. I think those sort of life lessons on, good and bad investor behaviors. So which ones to adopt, which ones to avoid. That's important enough that I want to give that its full attention. So I'll keep it here on the edge of my desk to next week.
Okay.
I'll just end on, one last life topic here, which is, it's been a big and kind of banner week for the Taggart family. I have a sibling who has been basically culminating almost like a decade-long professional journey, and ended up having to sort of present his case. And this has been like I said, like a decade-long journey in the making. He did that this week, and unfortunately ended up getting the news that he was hoping for out of that. I'm kind of going through my own thing, which I will hopefully be able to share publicly with folks relatively soon. But in the midst of all this, kind of like fighting the good fight for yourself, but also just for the people that depend on you, and really just trying to sort of like, kind of live your authentic self, and consequences be what they may. The whole process has reminded me of this great little paragraph written by President Theodore Roosevelt. I'm sure you're familiar with this, Lance, the man in the arena.
Yeah, we used to have lunch together. Great guy.
Yeah, you and Teddy Roosevelt used to have lunch together?
Yeah. That's how old we all are now. So
okay.
Yeah,
That's right.
Me, him, Methuselah. We used to play mahjong in the park on Fridays. So,
I just meant I'm sure you're familiar with this piece here, and I'm going to read it quickly because I also think it applies to guys like you and I who are out there every day, in the content creation world. So, anyways, this I think has applications for everybody. So let me quickly read it for those that can't read it on the screen here. It is not the critic who counts, not the man who points out how the strong man stumbles, or where the doer of deeds could have done them better. The credit belongs to the man who is actually in the arena, whose face is marred by dust and sweat and blood, who strives valiantly, who errs, who comes short again and again, because there is no effort without error and shortcoming. But who does actually strive to do the deeds? Who knows great enthusiasms, the great devotions, who spends himself in a worthy cause, who at the best knows in the end the triumph of high achievement, and who at the worst, if he fails, at least fails while daring greatly, so that his place shall never be with those cold and timid souls who neither know victory nor defeat. Now, Lance, I'm sure for a guy like you who, did MMA, right? I mean, you've literally been in the arena. You've taken the punches for your errors. I'm sure you've known some high achievement in there. But basically, this is an ode to perseverance, to grit, right? To dreaming and having courage, to standing up for yourself, to pursuing a goal, and just putting yourself on the line, right? And I think all of us, could use more of this type of affirmation in our lives, and this type of courage, and putting ourselves out there. You do it, every day as a capital manager, right? Not every call you're going to make is going to be the right one. You're going to err, right? But you're there trying to do the best thing you can for your clients. You're going to take their slings and arrows, and they're justified when they're going to call you up and say, Lance, why'd you buy that thing that didn't perform right? But you're in there. You're also doing the same thing, on your YouTube channel every morning, putting yourself out saying, I think this is what's going to happen in the market, but it doesn't always happen that way. So anyways, I'd love your feedback on this, because I think this is the kind of encouragement that I think we all kind of need in our daily lives, right? Which is to not shrink from the tough things, because they're hard and there's risk and, all that stuff. But, kind of the David Goggins style, like, just man up, woman up, grab life by the horns. And, you're never going to always succeed, but the rewards are in the attempt, really, at the end of the day. And that's what life is all about. So I'll stop my opining here, but I'd love to get your reaction.
It's absolutely right. So first of all, I did MMA before it was MMA. I'm old, right? So I was just doing full contact martial arts before, they commercialized it. So I don't want anybody looking up on MMA, Lance Roberts. I wasn't on MMA. It was before all this, but it was full contact, no pads, no rules. And it was brutal.
I think they just called it street fighting back then.
It really kind of was.
Mad Max Thunderdome. I don't know, whatever.
Yeah, but no, it was very brutal and very challenging. And yeah, lost fights, won fights. And when you lose a fight, you have a choice. You can either, quit, or you figure out what you did wrong and you go to win. And so, if I lost to a guy, I would go figure out what I did wrong and why I lost that fight. And then the next time I would fight him, I could win the fight because I had figured out how to fix those errors. Same thing goes with, I lived out of my truck for 3 years trying to build my first business. And, it was tough. It was a struggle. But once I got it finally off the ground and got it going, then, the success came after that. So, but all through life, there's been success and failure in everything that we do. And it's always interesting because, I talk to a lot of people and they're like, well, I tried to start my own business and, this happened. And so I quit. Well, when something happens, that's not when you quit. That's when you start, because it's easy to start a business. I can go out and, you see all these TikToks about, oh, just go form an LLC and then get this other LLC and do this and borrow a bunch of money that doesn't belong to you, then do this. And you're going to make all this money. That's all great, fine, and dandy, but that's not the way business really works at the end of the day. And, the difference between people that succeed and fail are the ones that failed in the process of becoming successful. Because for most people, the first obstacle is the obstacle they quit on. The guy that succeeds is the guy that hits that obstacle, figures out how to get himself back up, dust himself off, and start again.
Right.
And
as they say, failure is the best teacher, but you got to listen to it and interact with it. You can't just abandon it. Yeah.
Exactly. And it's a tough process. There's the old saying about there's no overnight success. It only took a decade. But it's a very true statement. And this is the one thing that bothers me more than anything right now. Whether it's on social media or just when I talk to people in the public, it's like, oh, well, the baby boomers had the best of it and we don't have any opportunity now. And that's such a load of crap, because there's absolutely nothing stopping you right now from getting up tomorrow morning, starting a business of whatever it is, and building something great. There's no restriction in this country that keeps you from building opportunity, creating something great. Adam started for nothing, created Wealthion, and now he's being very successful doing that. If he hadn't started it, if he hadn't tried to start it, it wouldn't exist. But here it is. And there's nothing stopping you from doing exactly the same thing. So if you have a passion, it doesn't matter what it is, go follow that passion. And yes, it's going to suck. You're not going to get paid for the first 2 or 3 years. You're not going to have health insurance. You're going to be living hand to mouth. It's going to be 80 hours a week. You're working on it. But eventually you will become successful. And eventually all the other traps and things that come along with success, you will have. But you've got to be willing to do the sacrifice to get there first. And whether, I don't wish you to live out of your truck for 3 years. That's not what I'm recommending, but that was my sacrifice I was willing to do when I came into Houston to build my business. But you can do it your own way, but you've got to be willing to sacrifice and understand. And one of the biggest mistakes I see of business owners when they start out, they launch a business and they try to pay themselves $100,000 a year plus benefits.
Right.
Can't do that. You'll be bankrupt before you know it. So you've got to be willing to sacrifice. You've got to be willing to fail. And when you fail, you've got to be willing to get up and keep going, because, if you stop, that's when you truly do fail.
So totally agree with all that. And we've talked a lot in the past too about, as parents, I feel like our paths, our time in the arena has informed a lot of our parenting style, right? And a big part of that is knowing how critical learning how to overcome adversity is, meaning you get knocked down a lot by life, right? But it's how hard you can get hit and still get back up, right? And for most parents, it's hard to see their kids suffer. They step in, they helicopter, and the kids never get the opportunity to develop, that ability to overcome adversity. The other thing about this too, and I think this is a big reason why Roosevelt wrote it, because he was a president that broke things, right? He really challenged, the status quo. He did a lot of stuff, kind of. He was a total maverick, right? And he had a lot of people crapping on him for it, right? And I think what he wrote about this is like, look, unless you're like in the arena getting smacked around, like, I don't care what you say, right? But a lot of people do, right? A lot of people don't start because, oh, this guy said it wasn't going to be a good idea. He didn't share my, my dream, or, I tried it and this guy didn't like it, and so I just gave up, right? Like, so much of this is looking internally and making that shift. I think we've talked about in past conversations where to fully step into mature adulthood, you have to shift from living a life based on others' expectations of you to living a life based on your own expectations of you. And that basically means, like, I don't care what other people think, right? Is it meaningful for me? And if it is, then I'm going to go do it. The last thing I want to say is on this is what I mentioned briefly earlier, which is, look, there are no guarantees in life, right? You may have the dream, you may pursue it, but the millions may not follow that you initially thought, right? But the value really is in the attempt, right? Not everybody who starts a business is going to be the next Jeff Bezos or Elon Musk or whatever, right? But if you are creating value in the world that is meaningful to you, and you are using your life energies every day to make the difference in the world that you want to make, that's winning life. As we talked about with the old people, right? And people live over 100. What do they care about? They care about relationships and meaning, and then health, obviously, but that's self-evident. Yeah. So anyways, if you were not familiar with that man in the arena, it's not a poem, it's a little, I don't know, quote, I guess. Reflect on that today and ask yourself, what is my arena in life, and how can I spend more time in it, and benefit from the glories of the victories and learn from the setbacks. It's a great piece of writing. All right, Lance, so wrapping up here, what trades, if any, did you guys make this week?
None this week. Probably within the next week or two, we're going to start shifting more of our short. So in our bond portfolio, within our portfolios, our bond section of our portfolio, we have a lot of short. We've got a good bit of kind of intermediate, and we've got a chunk of long duration bonds. We're probably going to shift more towards long duration next week. So we're kind of just watching here, kind of where yields kind of settle out over the next few days. But we're about to make another shift in the bond portfolio more to the long side. On the equity side of the portfolio, we're going to probably start within the next, we're still expecting this rally into year end. And then on that rally into year end, we're probably going to shift a lot of the equity side of the portfolio into high dividend yielding, deep discount value stocks to weather any type of economic downturn.
Okay. And Les, I do just want to point out real quick here that you are modeling well what a quality financial advisor does, right? Is you have to have the courage of your convictions, right? And you are you've made the case for a long time as to why you think long Treasury bonds are going to pay off well. You've kept us updated as you've been, first dipping your toe in the water on the longer end of the duration curve, and then you've been, increasingly adding to that, and you're continuing to. And I know that every week, every week that goes by that yields go up, you're taking more and more slings and arrows. And your job is to not do it dogmatically, right? And I know every week you and Michael are duking it out in your portfolio meetings to determine if this is indeed still the right thing to do. But once you've made that decision, you're doing it, right? And so, the slings and arrows will continue. And to be honest, who knows what's going to happen in the future? I certainly hope you're right, and I think you're going to be proven right. If not, you'll come back and tell us what was wrong about the thesis. But that's the point of a good steward of other people's capital, is that you're not being buffeted around by headlines or the winds of opinion. You're sticking to what you think is the right thing to do, and be damned what everybody else around the world might be saying about it.
And it's interesting you said that up. Like if I'm wrong on my interest rate thesis, I still win. And the reason I still win is because in order to have higher interest rates of 8, 9, 10% interest rates, we've got to have booming economic growth, which means the equity side of my portfolio, the S&P is going to be trading at 10,000 versus 4,500. So I win. And so, the great thing about where I am is I really can't lose. I may lose on one side of the trade, but I'm going to win on the other.
All right, my friend. Well, every week we'll give you the chance to keep us updated as to where things are going. All right, folks. So yes, if you've watched this, it means you weren't watching our conference. If you would like to order the replay videos of the entire conference, all the presentations, all the live Q&A, just go back to that same URL, wealthion.com/conference, and that's where you can purchase the replay videos. And as we say every week, and I think Lance did a really good job modeling the benefits of it this week, for the type of future that's coming, especially for the many reasons that Lance mentioned, that there's a lot of reasons to be kind of looking with trepidation going into 2024. You should work under the guidance of a good financial advisor, not just a good one, but one that takes into account all the macro issues that Lance and I have talked about here. That narrows it down to a pretty small percentage of the financial advisory world. And maybe, Lance, at some point we should talk about what to look for in a financial advisor, because even better than I that there is a ridiculous spectrum of quality out there. And for the types of advisors that really focus in the details of the macro stuff that we talk about, it is a pretty thin slice of the universe that's out there. But anyways, if you've got a good one who's doing all this for you, great, you should stick with them. But if you don't, or you'd like a second opinion from one who does, maybe even Lance and his team there at RIA, then consider scheduling a free consultation with one of the financial advisors that are endorsed by Wealthion. To do that, you just fill out the short form over at wealthion.com. Only takes you a couple seconds to fill out the form. These consultations are totally free. There's no commitment to work with these guys. It's just a free public service they offer to help as many people as possible, position as prudently as possible in advance of the potential developments that Lance has talked about in this past hour and a half. All right. Well, look, Lance, thanks so much, buddy. Everybody else, if you just think the highest and best use of humanity's time is to watch these weekly market recaps with Lance and I, then please let us know by hitting the like button, then clicking on the red subscribe button below, as well as that little bell icon right next to it. Lance, buddy, as always, you get the last word.
We'll see y'all next week. Have a great weekend.
All right. Thanks so much, everybody. See you next week.